way we differentiate and define thematic really has to do with taking traditional asset allocation methodologies, which usually are done by either asset class, geography, or even sectors, and sort of being agnostic to all three of those, and instead trying to vertically integrate an ecosystem within the asset manager itself. So what I mean by that is the asset class, whether it's credit, private equity, public equities, venture capital, or a particular geography, whether it's emerging markets or developed markets, we can blend all of those together within a particular niche theme and be very effective there.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Justin Smith with us. Justin is a managing partner at Recharge Capital and leads venture investments. In this episode, we talk about what's the mission at Recharge Capital, what is thematic investing, key focus sectors at Recharge Capital, some exciting portfolio companies, how Recharge Capital helps its portfolio companies succeed, their portfolio construction strategy, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember, there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Justin, so good to have you on the VC 10X podcast. How are you doing?
I'm doing good. Thanks for having me, Prashant.
Yeah, it's a pleasure having you on. To start things off, can we first talk about the mission at Recharge Capital?
Yeah, sure. So our mission has always been with VC investing, it takes forever to get your money back. And so we always thought there's got to be better ways to kind of like accelerate value creation and sort of shorten that process. And we sort of took this idea of like trying to integrate ecosystems within our asset manager. And so what I mean by that is we take this approach where we'll incubate companies and invest at the seed stage within three different verticals. And these verticals, we all have distribution moats built out that allow us to basically get our first set of customers, whether on the consumer or enterprise side. And it allows us to build a lot more efficient, as well as produce revenues early on. Those three areas are within the fertility sector, synthetic biology, as well as consumer fintech. So to give an example, we have business over in Southeast Asia, as well as here in the US, that we own a chain of fertility clinics. And what we essentially do is map out the workflows within those clinics, usually like a patient journey from beginning to end, and figure out different technology enablers as well as services that we could either embed into the workflow or upsell to the consumers. And so on the venture side of the business here at Recharge, like I'll take a look at companies that I can basically partner exclusively into these fertility networks that we own and control, which allows me to essentially invest and also be a customer at the same time for the companies we're creating. And our thesis is that, especially when you're investing at the seed stage, this allows you, it gives you a much better chance and hit rate at getting companies from seed through Series A, and gives them good case studies for them to then scale out their go-to-market strategies.
Right, totally. That's a very interesting approach. And a term that I first saw on your website was thematic investing, right? So what is that and how is that different from maybe a thesis-driven approach? That's a thesis in itself. What is it?
Yeah, totally. I mean, look, a lot of investors are thesis-driven in some way. I think the way we differentiate and define thematic really has to do with taking traditional asset allocation methodologies, which usually are done by either asset class, geography, or even sectors, and sort of being agnostic to all three of those, and instead trying to vertically integrate an ecosystem within the asset manager itself. So what I mean by that is the asset class, whether it's credit, private equity, public equities, venture capital, or a particular geography, whether it's emerging markets or developed markets, we can blend all of those together within a particular niche theme and be very effective there. So, for instance, within fintech, where we really specialize is in US consumer and more specifically within US mortgage servicing market. We've identified US mortgage servicing as a very underutilized channel direct to the consumer. And so our thesis is actually if you can automate better the servicing flow, you can make money there, but you can also have a really close relationship with the US household that lasts for quite a long time. And so we have data on the size of these households, the geography of them, their income levels, the number of members in their family, which gives you a really great distribution channel actually for building fintech products, whether they're credit cards, insurance products, whatever. And what we've done is basically kind of like attack the fintech sector from multiple angles. We've got venture capital, which uses both seed stage as well as incubation. We've got a platform asset, basically a mortgage servicing software that gives us direct relationships to the consumer, which is more of a growth stage / private equity business. And then we also have I guess you could call it a public hedge fund that invests specifically in fixed income, specifically mortgage servicing rights. And so what we do is as we buy up MSRs in the markets, we can actually have those MSRs be subserviced by our company. So we're able to create revenue that way. But then every single one of those MSR contracts also counts as a US household that we could technically upsell something to at a later date. And so when I say we try to do end-to-end vertical integration within the asset manager, that's what I mean. We have a credit fund, we've got venture capital, and we also have a roll-up strategy within servicers that allows us to kind of connect all the dots. And so we feel it's a much better approach and efficient use of capital to invest this way.
Right, totally. I get that. And it was also written on the website that thematic investing actually closes the value chain loop there, right? So can
That's
you
right.
give us an example of how that happens?
Yeah, another example in terms of closing the value chain loop, because we sort of try to identify these workflows from end to end and then capture value at all different points. So, like within synthetic biology, for instance, we have a company over in Asia that's a biofoundry, kind of similar to what Zymergen and Ginkgo Bioworks have done. That I've been over there. We have a bunch of fermentation pilot plants that were basically building out molecules and peptides that could scale into production for consumer goods. And so we own that R&D facility. There's been several $100 million put into that. And then we've got manufacturing capabilities as a separate business line that allows us to then scale manufacture different molecules that we've discovered. The last piece of business, the third layer of this, is actually having been almost like a holding company or a mini Procter and Gamble that can essentially create consumer brands that source their supply chain from our network, but also allow us to touch the end consumer. So when we say end-to-end value creation, it can be different for different industries, but in the case of what we're doing in SynBio, it's actually owning the R&D development, the manufacturing, and the end consumer demand.
Right, got it. Awesome. So that's a very interesting approach to investing that Recharge is following. And but I also heard that it's also going in different asset classes, which you mentioned as well, that there's a roll-up fund and there's all these different types of funds that are being operated. So are there like different dedicated teams for each of them, and are all of them like guided by some common strategy that's there on a specific theme?
Yeah, I wouldn't say there's necessarily a guiding theme that connects all the strategies together. I think it's
Right.
more of how these strategies developed was from what we believed would be amazing macro tailwinds with 20 to 30-year growth trajectories, and we wanted to build around them. And so that's how we came to conclude that fertility was a huge space. We went and did a ton of research into fertility. SynBio has been a big part of our business, as well as fintech infrastructure and consumer fintech. My partner and I have been investing in consumer fintech for a long time, all the way back to 2012. We've seen some companies do really great. We've seen many that have fallen by the wayside. And through those experiences, we've, come to the conclusion on why some of those companies failed and how we might be able to do it better going forward. What I will say is the way that we do invest into the future and how I see Recharge 20 years from now is continuing to develop out these anchor assets that we turn into basically business platforms that allow us to have distribution networks embedded into our model. And so, a lot of these are sort of born out of what we're doing on the venture side. I mean, all three of these were born out of what we did on the venture side to begin with. And so, part of our funds are also meant to be kind of like exploring the edge of research on certain areas, like within veterinary care, frontier tech, to figure out if there's other areas of technology that we could vertically integrate and start to capture all the value in those ecosystems. Longevity is another one. We've done some research into there, although haven't made any investments yet. And we've been doing stuff in digital assets as well with our other partner, John Lowe. So there's the way I'd love to see it is like someday, 20 years from now, we've got 12 anchor business platforms that provide us these distribution channels that we can continue to build off of.
Totally. Very exciting there. And let's talk about, you mentioned some of the focus areas for you, like there is women's health is one, fertility, that is right, and then there's fintech, and then so what are these core areas that you've picked, and why those specific areas? Where do you see the opportunity in those areas?
Sure. So I'll start with consumer fintech. I think the one thing that we've kind of noticed over the last decade is that we've been trying to figure out a way to digitize the consumer balance sheet and P&L. And some of the companies have been pretty successful with like point solutions, like Lemonade with their renter's insurance. But ultimately, much of the early growth was VC subsidized and brought on customers that were kind of low LTV. And that's been an issue with fintech for a long time. Is you can get 10, 20, 100,000 customers, but unless you're able to build up ancillary services and truly create a real platform, your CAC eventually catches up with your LTV, and there's a limit on how much you can actually grow. And our thesis around that has been that like no company has really been able to interconnect all the different areas of consumer finance in a way that people can, integrate with different areas of what they're doing and what they're spending their money on. A great example is like some of these apps that'll capture all of your spending habits and show you ways that you can save because you realize you're spending money on 8 different subscriptions and you're only using 3 of them. I think those are great, except for the fact that when I look at those, that's a point solution to understand my expenses, but it's not integrated with anything else that I'm doing. It's not showing me how much I'm really spending on groceries or breaking that down. And it's the same thing with like these integrations into my bank accounts. I can integrate into all these bank accounts so long as the technology app has a partnership with that bank that allows that integration. So if I have 6 different bank accounts and I'm taking insurance from another bank but not using any of their banking products, and there's no partnership with them, well, it might capture 75% of my finances. But if it doesn't capture that last 25%, then it's highly likely I'm probably going to churn at some point because I'm going to do this stuff internally myself so that I can capture all of it and not forget anything. So we really had a kind of an idea there. Like, look, if we can figure out a better hack into the consumer that allows us to kind of build from scratch and it gives us a long-term relationship, then this might be a better way of approaching fintech. Because then we can have a really low cap and it gives us much more runway to build. And so, we saw mortgage servicing is it's kind of a mundane business, and a lot of the publicly traded comps have not done well because there's not a whole lot of automation of the workflows. But because of that, they're very razor thin margin businesses, and they don't have really a whole lot of extra manpower or willpower to go and upsell consumers and add additional value. And so the first idea is, well, if we can automate away a lot of the labor costs for these businesses, that opens up the ability to build a closer relationship with the consumer and ultimately bring them more services. So that was kind of like the thesis there, and that's where we really see consumer fintech going. Is ultimately if we can start with a point solution like mortgage servicing, but then build on top of that and build LTV, we can really start to have a close relationship over time. And then within fertility, which is another huge area that we invest, I mean, the biggest thing with fertility is like birth rates for the last few decades have been in decline. People are waiting longer in life to have kids. Anywhere between 1 in 4 and 1 in 3 couples worldwide struggle to conceive, but it's been pretty taboo to talk about that for quite a while. And IVF is like super expensive. I mean, unless you're willing to travel and do medical tourism and either go to Spain or Cape Town or something to get this stuff done, you're spending anywhere between $20,000 and $25,000 on the low end just to get a cycle done, and the success rates on those are relatively low. And so if you are determined to have children and for whatever reason you can't naturally conceive, you're in for a pretty high spend to go and have a kid, which I think is ridiculous. And so we're doing a lot of business in Asia because with lack of FDA regulations, it allows us to try out new technologies that bring down these costs. The plan over time is to really bring down these costs and make it available for more people. Most of the solutions here in the United States and the roll-up strategies are very focused on the financing aspect. Basically saying, look, we've got a limited supply of doctors that do this stuff, and we've virtually got an infinite demand. Why don't we just figure out how to subsidize this a little bit so that we can keep people coming? And that doesn't bring down the cost at all. All it does is figure out ways of getting people to pay for it, whether it's through public sources or employers. So the business is still great, but long term, that's not the business that's really creating value for society. And then with synthetic biology, I mean, the biggest thing there is we saw companies like Ginkgo Bioworks, which I'm a huge fan of. They went public and essentially are trading down now 90% below where they IPO'd. And my opinion on that is the primary reason is because it's project-based revenue. I mean, these companies like Zymergen, they act as outsourced R&D for some of the larger conglomerates like a BASF, and they're getting paid on milestone payments and working on 100 different projects, but only a small subset of those projects actually become consumer brands. And then once they become consumer brands, it's another question on whether they become really awesome consumer brands. And so our thought around SynBio is well, this is hard to do and you need a lot of capital to do it, but if there was a way to sort of connect the whole value chain there and allow us to work on molecules and peptides that we believe we already have a market for, and we can kind of control our own costs and not spend money on developing a molecule that might get put into a product and that product is not even purchased, because that just turns out to be a big waste of money for everybody. And so our view of the future is that everything is going in SynBio, whether it's cosmetics, food, materials used in construction. They are more sustainable. They can be better for the environment in many ways, depending on the type of tool. But everything will be SynBio enabled at some point. Now, a lot of things already are. There just hasn't been great education around it. Most people kind of correlate SynBio to GMOs, genetically modified, fruits and vegetables in the grocery store, which has gotten a bad rap for various reasons. Some good, some make sense, some don't make much sense. But the point is there needs to be a lot more education around it, because when you walk into a Sephora right now, there's a ton of synthetic biology-enabled products, and people don't even realize that. So, in a nutshell, basically, we think these three areas pose the potential for extreme exponential growth over the next few decades.
Right, totally agree. And can you also share some of your portfolio companies as an example of how they are solving some of the biggest problems in these three areas?
Sure. So the first one I'll talk about is RIA. That's our fertility clinic business over in Asia. RIA is sort of a hybrid business of both acquiring clinics and building them greenfield, and then acquiring technology businesses for control that they can embed into those workflows. So an example of that is, RIA will buy clinics and then buy a technology enabler, such as a company called NT Labs, which is another one of our portfolio companies. NT Labs is a specific type of technology around egg extraction and measuring timing around cycles to figure out the best time to go in and extract eggs. That type of technology would need to go through, multiple regulatory hurdles in the United States to be distributed into clinics. We're not there yet, but we can use this technology in Asia. And so by making investments both in NT as well as RIA, we can combine the two businesses and essentially have a more cutting-edge technology-enabled workflow for patients that are coming through our IVF journeys. Valon Technologies is another example within our fintech business. That's a mortgage servicing platform that I talked about. We've been investors in that business since inception. And what Andrew Wang did with that business essentially took a very broken servicing workflow that is highly labor intensive, and when the labor is used too much, it often loses money and becomes unprofitable. And we've slowly but surely cut away the labor with automation and different AI applications that allow us to make sure that when we're servicing mortgages, we're doing them with the best unit economics you can possibly get from any mortgage servicer across the country. And so while we will go out, obviously, and we're incentivized to work with other buyers of MSRs so that they give us our contracts, we're also vertically integrating on top of Valon by building products. And so one of the companies that we helped incubate just recently, called MCard, is very similar to Built Card that a lot of people are familiar with, where Built Card is used for people to pay their rent and allows them effectively to build credit as well as earn points on that rent. M Card is doing the same thing, but for mortgages. And so you can use your credit card to pay your mortgage. And you can earn points that way. And then you can go and use those points on partnerships that are tangentially related to a mortgage holder, such as buying furniture at Wayfair, buying some sort of home improvement stuff at Home Depot, and you can get additional cash back from using the card at those places as opposed to using it at other places. But the special sauce is really in we create a credit card company that normally would have to go out and market through some sort of sponsor bank or on Facebook or Google or whatever their go-to-market strategy is. Our go-to-market strategy starts with the mortgage servicer because we already have ownership in a mortgage servicer, and we already are catering to hundreds of thousands of U.S. homeowners, and so we have direct access and we can sell into those U.S. homeowners because it's within our ecosystem and build out a company from scratch very quickly. And so those are just a few examples of the actual portfolio companies we have and how we're executing on this strategy.
Right. That's very interesting. And while you're evaluating the deals, one focus is, of course, they should be aligning with the themes that you're focusing on. But besides that, what are the key things that you're looking for in a company?
Yeah, I mean, I think like every other venture capitalist out there, like the founding team is super important. I think once you've done enough investments in this space, it's not that you're ever perfect at reading people, but I think some of the intangibles and the trustworthiness of people and what they're going to do with capital is really important because ultimately, once we wire money over to the bank accounts of these startups, they are really the fiduciaries of the money and making decisions on the ROI for each one of those spend, whether it's spending money on Facebook for performance marketing or investing in another engineer, another BD. I mean, there is an ROI for every single spend that you do. And ultimately, I'm not the one making that decision. I'm making it on investment by investment basis, but within that investment, the founders are making decisions on that. And so, we only will do 2 or 3 investments a year, and I like that because it allows us to really get deep with these founders and develop a trust so that we can, relay ideas off of each other and build together. But other than that, I mean, the biggest thing is obviously investing in a way that we can leverage our distribution systems because that's where the edge really lies. So, I need to know that this particular company is filling a hole in my workflow that is either an inefficiency or some sort of bottleneck. And I need to know that that my business platform company, my anchor asset has an interest in working with them. And so that is really a big prerequisite for making sure that we're going to put capital into something because we know we can drive revenue there very quickly. So those are probably the 2 biggest things up front that we look for when we start to underwrite. But I will say, because of our focus, it really does allow us to spend time where we know we can add value as opposed to just looking at everything under the sun. Because as much as I love to do that, and you learn so much from like looking at all the, meeting all these founders and looking at all this tech, you only have so much time in the day. And when I have discretion over capital that I'm, deploying for LPs, I want to make sure that I'm very efficient with that capital.
Yes, totally agreed. And I think Recharge, because of that thematic focus, has a very focused platform focus as well, wherein you help your companies a lot better than maybe how a generalist firm would. So tell us more about that aspect of how you're helping your portfolio companies succeed.
Yeah, I mean, we try to look at. I mean, venture it's tough because at the end of the day, we're capital providers, and we're giving capital over to a founding team that they have control over the decision making, and so there's always like kind of a gray area between how much influence you want to have on a company versus how much you need to just let them run because that's why you invested them in the first place. If you didn't, I would just fund myself and go build it if I thought I could do it better. So I think the biggest things that you can always add is bringing revenue or bringing great people to their team. So obviously, like most VCs, I mean, if there's somebody in our network with a particular skill set that we think would plug in great to the business that we're building, we obviously try to do that. Within distribution and setting up the go-to-market strategy, I mean, that's the biggest one because I think what people really underestimate, especially within enterprise sales, is like getting that first customer is so hard. And a lot of people will get, initial pilot customers. The problem with a lot of the pilot customers a lot of times is you're developing customizations that you wouldn't otherwise develop because you want to keep that business. And those customizations just don't scale. And that's a time and time again issue. And so, we obviously know those issues and we're purposely trying to develop the product through the relationship with their anchor asset in a way that is scalable, because that's the entire point of it. So I think those are probably the biggest ones. But the other one is especially when we incubate, I've always thought it's extremely important to have somebody on the cap table that has deeper pockets than I do. Period. And so every single business we've ever done, there's always been some sort of capital partner on there with a pretty high percentage ownership that ultimately probably is the leading person to lead the next round, or at least some later round. And I find that really effective. And I think it's also effective not just for the company and giving them a line of potential capital later on, but also for limited partners that are looking at our strategy and saying, it's great when these guys have a little bit of signal because they can get other people to partner with them. And I think that's important. And I see other VCs that do that, and I think it's a really great idea. So and opposed to basically us incubating a company and taking 100% of the round so that we can have the ultimate economics in it. That's not really the goal. I would rather build something with others and continue to build on top of that and build that relationship and do it all myself.
I totally agree. Yeah, that's an interesting front on how much share do venture studios or maybe incubators take up in their own companies, right? Because you have to be also cognizant of how over the lifetime of the company, because eventually it has to raise bigger rounds from maybe other investors, and would the cap table still look attractive to them, right? So how do you think about that stuff, and how do you place Recharge just rightly there so that it doesn't bother the future investors as well?
Yeah, totally. I mean, I wouldn't classify us as a studio. I mean, we invest at the seed and then we'll incubate if we really think that we can have an outsized influence on the business at the beginning. But it's a tough thing that studios struggle with, because you come in and you might have a great idea and you find some great founders to do it, but that initial way that you cut the cap table, you really have to make sure that it's almost like the founders need to get as much equity that they would get if they had the idea themselves. Otherwise, you're always running the risk of adverse selection and bringing in somebody that I guess might have not been able to raise capital otherwise, unless you had the capital basically set up for them with the idea. And so when we create the businesses, I mean, this kind of goes against sometimes our fund economics, but the percentages that we take off the top are, usually anywhere between 10 and 17.5%. I mean, they're not huge. But we do that, and then we have capital reserved for the follow-on to keep and maintain that. But what I really want is I want a bunch of partners coming in and being incentivized to come in, so that, to your point, the cap table remains attractive over time. And through 2020, 2021, and 2022, that's easily been one of the biggest issues with VCs. So many of these cap tables are so unattractive, mostly because of too high evaluations. But in some cases, not even that. Sometimes it's just their previous round was taken entirely down by one investor and they kicked out everybody else. And so now you don't have any other champions in there, and that investor's tapped out for whatever reason. And so, I think there's something to be said that when you're incubating something, you obviously should have a little bit more skin in the game because you've spent the time and resources to do it. But I think playing nice in the sandbox is the future of innovation, and I do think it's the right way to invest in innovation.
I totally agree. And how do you think about portfolio construction at Recharge? What all key components need to be there across the three themes? And also, how much reserve do you like keeping there?
Yeah, so the way we think about construction is basically at a high level, 90% of the capital is used to build and invest in companies that can plug straight into the distribution systems. The other 10% is more for opportunistic ideation around what could be a future anchor asset vertical we could build into. And let's either build or invest in a company that gives us an opportunity to do that. Within the 90%, the way we usually look at it is let's call it a 4-year investment period, I'll probably do about 11 or 12 companies. So about 3 companies per year, and give or take 1 company per silo, basically. So 1 healthcare company, 1 fintech company, and then 1 company in the consumer brand space that's doing direct work with our biofoundry. I think that's a good cadence for basically, more or less, it's a single GP entity. It's just myself making the decisions on the investments, and so it's what I think myself with my partners that work across the platform are able to handle and do effectively. over time, I do think that we can scale this strategy. But this strategy is not meant to be doing 150 investments over 4 years. It would be untenable, and we wouldn't be able to have as an outsized effect as we do now on being able to generate revenues for these companies as they come out to market.
Right, totally. And now coming to my last main question before we move on to the rapid fire round. And this one is, what's been your biggest learning investing in startups over the years?
Biggest learning overall is, I've seen thousands of decks, met tons of founders, and very grateful for that. And learned so much. I mean, it's always great talking with constantly every day getting to talk to people that are smarter than I am and just know more. And you can constantly learn. It's the best job ever. But doing deals and actually transacting, I realized that developing a level of trust both with the investors that I'm doing the deal with as well as the founders is the single most important thing. Because shit happens later on. Everybody, incentives do start to misalign over time. The longer that you can keep everything aligned, the better off you're going to be. And every deal, I think that we can go back over 12 years now and, kind of debrief on why things didn't work out. It always has to do eventually with some sort of misalignment between founders, investors, or intra-investors, and everybody just not being on the same page. So that's been near and dear to me, and also something that I think has been my biggest learning experience over the last decade.
Great. All right. Now let's do the rapid fire round wherein I'll ask you 5 quick questions about the investing you're doing. And you have to give 5 quick answers, right? So the first one goes, what are the sectors and regions you invest in?
Fintech, healthcare, synthetic biology, US, Asia.
Great. What's the typical stage of investment?
Seed stage.
What's the typical check size you put in?
Anywhere from $500K to $2 million.
Where can founders apply for funding in case there's a direct way?
Either emailing me directly, going to our website, or finding somebody that I know and doing a warm intro. Any of those really do work.
All right. Last one. Where can our listeners follow you?
LinkedIn.
Okay. All right. I'll make sure to put all those links in the show notes below. Thanks so much, Justin, for doing this. Loved all your insights, and you're doing important work. So thank you so much.
Thanks, Prashant. This was fun. I appreciate it.
Thank you.